Hello traders, apologies for the little delay, but we're all good. I'm trying to start my video. Oh, there you go. Excellent. I trust you all well. I'm in a bit of a little different environment today. So you can see how I'm kind of leaning over, leaning over everything. Reason for that is the interesting times that we are having right here in South Africa. Power cuts, load shedding, electricity, we've got generators going, we've got inverters, with all sorts of things. So I'm on a different laptop, different platform, but all good. I trust you all well. So what I'm gonna do is, if you don't mind, I'm gonna switch off my video for a while. The angle is distracting me because of the environment, but I'll come back and have a chat with you guys. All right, let's have a look at the exciting price action we're having today. I want to start with UK 100. So this is a different setup than I usually have, but by now, please trust all the traders would have. If you trade in the 5 minute, you'd have already gone in and put in your extreme highs and lows of the previous day. So I'm gonna just go ahead and do that right now. Period separators. So again, my apologies for this. You know, we got hours end of power cuts, but we are getting by and we are making decisions. So this is our low of yesterday. So typically all of this would have been set up already on my charts, but I'm going to do it now while we go ahead, which might give some of us just an opportunity to see how I set up the charts for each day. High of yesterday. Okay, I know when I'm on Zoom presentation, when I click on some of these properties, as you guys advised me the other day, it's not, they don't pop up, they open a different window on your machine. So, you know, I can talk through them if you want. So as it is now, just on the fib levels, actually you don't need anything else on your fib levels, just clean them up completely. Okay, so we can pick up the midpoint of yesterday, absolutely critical. Now, what is fascinating about what we're getting on UK 100 is, I think possibly there's a higher probability that what the market is doing now is trying to create a tail on the bottom of yesterday's candle. If you have a look at yesterday's candle. So there is yesterday's candle. So I'm going to hide that feature just on the 5 minute. So again, if you've just come in and just switched off my video, I will switch it back on just because of the environment I'm in. There is yesterday's candle. Remember, we always need to look at the 3 previous candles. So here are the 3 previous candles where that 1 bar trading range. Okay, whenever you see a 1 bar doji, it is a trading range, and you expect there to be a failed breakout in one direction or the other. So in this case, we had a huge sell-off at the open, which is going to almost immediate move of that 1 bar doji. So this buying that is taking place is not a surprise, and also at a key level of support. So the bulls want to create a bull candle, and all they need to do to convince market in control is got over this 50% pullback of yesterday. So if we have a look, the trades that you should have considered already by now, I like to, well, I'm doing it now because I'm using my charts for presentations and coaching traders, etc. You ought to have marked the open of the day, which was this bull candle here. Okay, so that's probably not as accurate. So that bull candle, bull, not bull, not blue. Okay, I'm gonna just mark it in yellow for us. Okay, so that's in the wrong place. So that bull candle was the open of the UK markets. Now, we had this sell-off, and sell-off, as you can see, if you go and mark the low of the Asian session and the high of that trading range by the time the market opens, so that low. Fib parameters you need to add in 200. So the market got to the measured move. That was the objective, that was the goal, or almost to the measured move. So then, huge sell-off, which also is continuation of the sell-off from the Asian session. Go down here, we create the double bottom. And in fact, the first double bottom was here. For those who attended the course that I had on trading the open on Sunday, I always say find the pattern first. So this was the pattern. So this is a measured move. Let's just clear that so we don't have any. Okay, so that's to the measured move. There is a pattern, double bottom. Okay, so we're always looking for that pattern. There is a pattern. And then when you have the pattern double bottom, you wait for the pullback and the higher low. Now, when you got this higher low, so there is a double bottom, good strength by the bulls from the breakout and the pullback and a huge bull candle. That bull candle, if you had taken that candle on its own as your entry after the double bottom, then your stop is a bit low. Now the low is here, so that's where you put your stop. If you want to take that candle and you want to wait for a breakout pullback, and we spoke about that, there is a decent enough breakout pullback for you to have taken. So you could have taken that trade and put your stop here, and then wait to see what happens when you get to the low of yesterday, key level of, it was resistance coming down, and it was support coming down, resistance, resistance, resistance. So depending on what happens here, so far we've had this bull candle here. Okay, good strength for the bulls, but it wasn't the breakout candle, because you can look to your left, all these lower highs, the market had to get above that. The market did, and then pulled back, and then it's carrying on. So if you still want to get into this trade, now you gotta wait. You gotta wait for the pullback from here. But we need to just this remember we said I think we should just mark it. That's the midpoint of yesterday. Range of yesterday. Midpoint of the range of yesterday. But just below that, so that's a level of resistance. Now, just below that, we've got the current high of the day, but I'm going to call it high of the Asian session. High of Asian session. Let's just try and visualize that on 5. So if you're looking to get into the market, now these levels of resistance, the bears are going to defend the area high, they want to defend the 50% pullback. So we gotta wait to see what's going to happen when we get there. What we're looking for is almost like, like this, but we need a breakout above that and a pullback. And when you get a pullback from the breakout, which means the market is broken above it, it's pulling back, and the bulls want to have momentum, then we can look to take that trade as a higher low, and our stop will have to be somewhere down here. Okay, that's a key level. So we'll just need to just hang around and wait a bit. Now, if I just have a look at, I know some guys were trading right from the open of the day, not just the open of the US, UK markets. So this is quite interesting in terms of the strategies that we spoke about. So there's the first candle of the day, second candle, inside candle, and that's a bit of a problem for the bulls. Now we're saying the bulls are strong. We need an inside candle that completes the first candle. One of the things I spoke about in the course is we need this inside candle to be closing, not as a breakout, but just below the high. So we would have needed this inside candle to have closed just below the high, and then that would complete this particular candle as a breakout candle with a pullback, and you could have taken an order, put an order above there and get. But we didn't get that. Remember, in the course notes, I said if you see a doji, just wait for more information. So that's a doji, then just say, okay, I'm just going to wait and see. And you would have, which you should also just really train yourself as a habit, to put a measured move of the first candle. So any first candle, whether we get there or not, put a measured move, because that's a bull candle. If it had been a bear candle, bear inside, you could have also just come in and put a measured move and say, well, if at the open will break out, that's immediate target for the bear. So the immediate target for the market going up was here. And, that's a test of the measured move. Bulls broke out, of course, above this doji in this candle with the tail. Then that weak follow through. Then one of the patterns we spoke about, when you see a reversal, wait for the second entry. So there is a decent enough reversal, and the market came back, and you might be saying, oh, okay, let me jump into that. Now, let's talk about that a little. If you jump into that particular trade, this particular trade here, it's a low probability trade. And the reason I'm saying that, remember I said we need to have a little bit of separation between candles. Okay, so there is a pullback, market tries to go up, try and allow at least 2-3 candles to go by. But if you see that and you say, I think I'm going to take it, remember the golden rule. That first trade, stop must be at a measured move. Okay, so it's not quite setting up. So your stop would have been here for that if you take that trade. And remember again, if you look at the course notes, capital allocation and capital management is absolutely key to how we trade, which means we're only going to put in 0.25% on that first trade. In case we get stopped out. The first trade is a reversal trade, because even though it's set up, we're looking at the reversal of market and see how far we can go. So you could take that trade and put it there with 0.25%, or you wait and say, okay, I'm going to wait and see. I know you're going to get this and watch the video. Let me just put. potential trade areas. I'll also put the stop in just now. So you will put an order beneath that. If you didn't get into that, so I'm going to wait for the separation. There is where you can put a trade and order beneath that, or beneath this low high. So, and remember, when I show 3 possible areas where you can take a trade, you don't have to take all the trade. In fact, don't take, you just take one. Point is, if you didn't take a particular one, you don't stress or worry about it. You wait for the next setup. So one of these 3 trades will be suitable, and your stop is going to be the same. So within there, that's a measured move. And you'll see also in terms of making sure that even if you put a stop at a measured move or at a lower, higher, low, always a protective stop. So that measured move is fine. But you see here we have 50% the midpoint range of yesterday. So just above there is a nice place to put your stop. That's it. And your goal is to see if we can get to the measured move here, or to test the low of yesterday, because low of yesterday, the bears are strong. They want to get down to that particular low of yesterday. That's where the bears want to go. In any case, you got rewarded. There's nothing else you would have looked to jump in. This little pullback here after the bear breakout beneath this pattern, this pullback is profit taking at number 1, the measured move of this candle, and also, you know, we said you must always look at any levels of your session. This high and low, you know, those trying to reverse the market here. That's why we're this, and the market carries. Could you take that trade? It's a low probability trade. The reason for that is you're selling straight into this level of support, low of yesterday. So I wouldn't take it. You know, if you really think you want to take the trade, the stop has to be up here, and you're hoping that we get down. Let's put it in. So it's a low probability trade because it's selling into when they use the measured moves. So you say, well, there is a breakout. There is a bear breakout, and if we get to the range of the actual breakout, then you're hoping that the market gets here. The market got there. Now we look at it, looking and say, oh, look, the market got there. So that was a good trade. But when we were taking the trade here, this level would have been problematic because the market could have just bounced off and come back and stop you. So I wouldn't take that trade. But if you want to take it, quarter percent, the stop has to be up here. That's the lower. So the stop from there will be down here. And be willing to wait and see what happens. So further on, I mean, there really is nothing more to do. Could you take that trade beneath here? Well, remember at this particular stage, all you can see is this measured move. That's what you really can see in the market getting here. So if you're taking this trade, you don't know that it's going to go that far. So again, breakout pullback, you can take it, but low probability trades. So I'm not going to mark them, but you know, these are trades that you could look at the questions. Yeah, if you're trying to go one-to-one, I mean, you need a huge take profit. So it's best just to wait and see. Where would you trail your stops? So if you're taking that trade, that's something that we must just look at very quickly. We spoke about trading stops. So remember, all our initial trades, there is a stop. As the market breaks out and pullbacks after this particular point, you can comfortably just pull your stop down to this level. So that's the nearest technical level, that high. Okay. Then as it does this pullback and starts to go down again, if you haven't decided to take your profits at this level, which you can do, I mean, that's a legitimate place to take your profits. From there, you say, I'm just going to take my profits here. But if you haven't, as the market starts to accelerate down, here, you can pull your stop to here, which is just above that technical level. And then you get this, oh man, I got measured move and a bit more. At this particular point, it's quite right just to make your profits. Because you've achieved the leg one, pullback leg two, the measured move. If you've taken your profits here, well done. That is also the absolute correct place to take the profits from. And then, when you get failed breakout, the market goes at bull. So you gotta manually close your trades if you haven't done so already. So once that is done, now we gotta kind of look. It's now a completely different market structure. I need to mark for you the opening of the European markets somewhere. Remember, in the course we said you have to be a little bit careful. Or not careful, just be aware that the open of the European markets overlaps the open of the UK markets. So it's considering that trading the open is trading the first 90 minutes. That's the first hour and a half after the opening candle. Because of the proximity of the European and the UK open, just consider the whole open of the European markets to last the full 18 candles after the open of the UK markets. So you ought to have had every time there's a key level, you must just mark it on our charts. So now after that whole bearish move, from the open, we have a new lower high, which as this was taking place, this was the low of the day. Okay, this was the low of the day. The market is going up, and because now we can see what's happened, right? But before we see all that has happened, we kind of think and say, hang on a second, is there an opportunity for me to be able to sell again in this particular market, or is the selling done? Because even though this was a weak breakout, failed breakout, pullback, but there was follow through. So the bears may still come back and want to sell. So you got to be looking at the market and being aware, of course, when the opening is coming. But in this particular setup, we didn't get any decent setups for us to have traded. If we get double tops, pullback, lower high, we could have looked at that with a stop above there. Now we're going straight into the open, failed breakout. Above that, the bulls are trying to break out above the low of yesterday and to reverse this whole selling. As far as the bulls are concerned, they're saying, hang on, yes, they've been selling, but the bears have achieved their objective. So if the bears have achieved their objectives, let's start to buy. And at the end of the day, we end up and say, hey, there was a huge tail at the bottom of the day. Well, this is how the tail is created. But we're still testing the low of yesterday. So we're not buying anything. If we're going to buy, we have to wait for the market to get down to the levels of support. We got to think of ourselves, we are traders. And think of yourself I give this example that if you had a small business and you lived next to a primary school with kids that love sweets and love, frozen ice drinks and whatever, and you want to sell to them at, kids might buy at 6,950. So you're not going to go to your supplier and buy here, right? Because if you sell here, yes, you do make money, but you're buying too high. So you want to buy as low as possible. So if the market does get there, you make as much money as possible. So that's the whole point. We're not buying here, we want to buy down here. So we don't want to buy here. We're still looking for ways to sell. Failed test of yesterday, market pulls down, but look at the weakness at the open, no strong back candles. We keep watching. Bulls trying to break, they fail. Now we get a lower high, but still we're looking for a bit of acceleration down by the bears before we can consider selling. The bears have a very weak sell-off here. If we'd gotten, if this setup that we had, this whole setup from here to here to here, if this had been occurring below the low of yesterday, we'd say, hang on, the bears are strong. They're creating a wedge pattern below. But this is all taking place that a trading range has been created. There's no evidence of strength. We then have this attempt by the bulls and a huge bear sell-off. Beautiful candle for the bears, but the problem is before we've seen all of this, we are here. There is a level of support. Again, it's a low probability trade. I mean, we've seen how many? 1, 2, 3. Low probability trade because we don't know this is going to happen. I don't like taking low probability trades. It's a good point. Who executes low probability trades? Scalpers. If you're scalping, you're going for small movement in the market, you are very comfortable to take a low probability trade. It doesn't bother you at all. So scalpers would have taken that trade and say, well, if I get a bull candle, I'll get out. Going around there. And if they had seen that reversal, say, oh, we're going back in again, they jump in, prepared to get out as soon as they bull candle, they get out. They probably have bought somewhere here and just hoping to see get out beneath a bear candle. It's very stressful, but if your mind can deal with it, fantastic. So a scalper would have sold that, saying, I'm aware that there is a possible, there is a level of support here, but I'm going to take my chances. So they would have been rewarded and gotten out here. But we're looking to get trades that we can hold on to. Then we get this, and we've kind of spoken about that a little bit. Now let's show something else that you always need to put in on your charts. Trading range. So every time you see a trading range of any sort, you need to have a measured move. Reason, of course, by now I think after the course you get a sense of it. Bears are saying, well, if we break out the new fat, we want to get to a measured move. To get to a measured move, we're satisfied. So as a bull, you're not buying. As a bear, if you want to take a trade and your stop is up here, and if you're quick, you say, okay, if it turns immediately, I'm happy to take a loss. So I'm trading like a scalper. But you see the breakout, there's no point jumping in now because you can't ignore the measured move. So scalpers can jump in here. And I know some of us enjoy scalping. So by all means, trade small. And of course, scalpers trade small. They probably trade in 0.25% all day. You're not going to go in as a scalper and be putting 1% in the market. So trades very small and be able to get out and take a lot of trades. But what I'm sharing with you is the need to be able to wait for this setup so you can place the trades and you can go away. So you would have definitely been rewarded up here in the morning. And I didn't talk about, oh, and I did, by the way, that's a trade not have taken that. But if for any reason you had taken it and kind of convince yourself to take it, your stop is down here, you would have to get out up here. That's a low probability trade for scalpers. We would have taken one of these trades and trailed our stop down. And if we decided to take money, we would have made money. If we decided to exit, here we would have just exited, that's fine, and wait for the next opportunity. The scalpers would have jumped in there. So now we see this and we say, hang on a second, this makes sense. I'm trying to find an opportunity to get into the market here. We're turning it a measured move of that particular trading range. Now the factors are building up. Here we said, well, there's a measured move, so there's another measured move here. So two invisible levels of support, but they do exist. Computers see them, and price action traders like yourselves, you see them. Now you get to see these things. So when you see that, you're not surprised. Say, okay, big tick, I have a low at a level of support. So maybe the bulls will be able to give me a double bottom, which I can happily trade. So when we see this now, it gets quite interesting because we're waiting to see if we get a double bottom down here. Bulls accelerate, which is fantastic. Doji, they're trying to break into this trading range and reverse all of this. We have a lower high. Okay, now this is one of the patterns we spoke about, but it's not happening. It's not taking place at the open, but it's a valid pattern that, as you start to look at charts more and trade more, you can quickly say, okay, this is the same kind of pattern we've seen at the open, so happily I can look to trade that. Look for the second reversal. There is a first reversal done. There is a second reversal. Failed breakout above this level. Now, I'll talk shortly about whether you should take this trade or not, but let's just so for the guys who are going to be joining me on the year-long coaching, we put all of these patterns together into actual trading, and you can now start to see how you can trade all day long whenever you're in the market. So there is that lower high, lower than that, lower high, failed breakout above that. So this is a higher high double top, and that's a reversal. But what else? What else is a level that I should be looking at? So we're at an outside candle here. Remember we said an outside candle is a trading range. So trading range, there's a breakout beneath the trading range. We expect it to fail. So we could have done a measured move somewhere within here, but the bears broke out beneath the trading range. Excuse me, guys. The bears. By the way, we have well over 85 videos in the archives of live trading profits. In the early days, it used to be an hour show. Now it's 45 minutes. And right in the very early days, I would say I'm going to just look at this particular structure. So you can go through some of the first bunch, maybe out of 30 or so, it gives you titles of them. Thereafter, we just start looking live, market only. And you can pick any at random and start to see if things start to make sense. So breakout beneath that. Now, this one bar trading range here is just as powerful in the market as this whole trading range. So just as we marked breakout of a trading range, that one bar trading range, it is a trading range, it's significant. So we got here. Okay, so you wouldn't have taken that to say, well, we probably want to get this out, wait a little bit more. Now, there is a reversal at support, at resistance. Okay, so we broke through, so that's resistance. There's a reversal support. That's a trade that you can take. Now, if you take in that trade, where do you put your stop? Okay, your stop has to be at a technical level. So two ways, or one way actually. One way is a measured move. That's the way to do it. And then you look at the nearest technical level. So the low of yesterday is your key level. So it's legitimate to put your stop there. Now, we're doing that because we don't know that the market is going to turn. We know there's a possibility of a double bottom here, but you kind of say, well, I could get my 1-to-1 or maybe just less, but you might get a little bit more like we had here. So I'm happy to place a trade there. So that's where your stop will be. And your entry. Again, I have to emphasize, guys, you don't have to take all the trades. It is not necessary. There's always enough opportunities in the market. But when you see a trade, sometimes you get gifts. Probably had me on the course saying there was a gift. Sometimes it's like, wow, a gift. So you take that trade and you know there's a potential place for a double bottom here, but you don't know how we're going to get there. So you take that and let's see what happens. So the market triggers you in and it pulls back and it gives you another opportunity. So if you hadn't taken that trade, this trade, you have to take this trade. Okay, that's one of those has to. Because, that one we don't take, we wait for the high, so that reversal. But when you see that there's a clear wedge, 1, 2, 3, markets try to go up 3 times and it gives you, as perfect a gift as possible in terms of taking the trades. So beneath that, you just put your order. So we put the order beneath here. And the other reason that this is an even more exciting trade, because now you're taking away, your stop is just here. You don't have to put your stop all the way up. Stop is just above here. There's a breakout point. And you're still hoping to get down to this level. Okay, so that became the higher low double bottom. And you can see, this level is exactly the same as our measured move. So you can set your take profit here. The market comes down and doesn't get your take profit, hold on to your trade. Or if you see this and say, I may be wrong, might be accelerating, take whatever profits you've got at that stage, just bank and wait. Okay. So if you hadn't taken the profits, the market comes back and does reversal, you would have ended up at break even. So at this point, you have to take your profit. Bears not accelerating, bears dodges, so you should have taken the profit. Then we kind of spoke a bit about, well, let's talk a little bit more just to complete today's picture. So we get here and there is a double bottom that we got. It is a double bottom, it's a high and low double bottom. You see that and say, okay, I've got the double bottom, but I don't trade the double bottom. I want to see bulls coming off, coming back, and then give me an opportunity to jump in. So that's a good enough for the, it's good enough by the bulls. What is ideal if you are taking notes in terms of a gift trade is if the bulls are accelerated off here, and if they had given us a full candle above the moving averages, so they've managed to reverse everything here and given us a full candle above it, and then come back, more often than not, we get a decent enough reversal candle before you get this breakout. But in this case, we didn't get that. That would have given us early confirmation of bullish strength. We didn't get that at that particular stage, but we then had this huge acceleration, confirmation of bullish strength. This is where, if you want to jump into the market, here there is a trade that you can take. And remember, key point, no matter how much you've banked here, we're taking a fresh reversal trade. I always, even if I banked a few bob here, I always go into 0.25% on every first reversal trade. So that's this a breakout, pullback, that's a trade you could take. I'm trading above this candle. And stop is down here. So the reason we trade in that, of course, is kind of track this trade. Everything is set up for us. And we say, no, if this goes away, there's a higher chance that we'll get a measured move of this breakout. And we got to that, so you have the role of 1-to-1. Now, just before we go, let me point out something which we mentioned earlier on. You see, this inside candle here completes the first candle. That's why we can take that trade. Okay, tail on the bottom, which is a low test of key support, these EMAs and the breakout point above here. So the market broke out here. That's where the bulls broke out. So that's been tested, fantastic. And it stays inside that breakout candle, so it completes that candle, so we can take that. Earlier on, why did it open? I mentioned that if this candle had completed, the first candle would have happily taken that. Now you can see the difference between this structure and that other structure. So that's why we didn't take that particular trade. So there's still the US session to come, and I hope you do stay in the market. What you should be looking for at this stage is what happens when you get back to the low of yesterday. You want to be looking for double bottoms. Okay, breakout. When I see the market going up off the low of yesterday, okay, then we see a higher low, then we can look to trade. So you need just to wait patiently. It might happen now, it might happen in a couple of hours' time when the US market start to open. So that's kind of where we at, guys. Sorry for switching my video off, just in a different environment. Standings, you want to look at you, but trust you found the session pretty useful. We will catch up with you next Wednesday. This show will still be on at the same time, but it's also the second Wednesday of the month. Please ensure to register for the 3 Wednesdays in the market with George. Hang Seng 50 opening, European, UK markets opening, and US markets opening. Absolutely look forward to having a good time with you together. Take care, guys. Marlon, thank you, sir, for hosting the show for us.